From New York City for our viewers worldwide, I'm Katie Greifeld in for Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, Iran and the U.S. announced that the Strait of Hormuz is open. Stocks surge, oil falls, and yields slide. While global leaders warn the economic impact of the war will likely persist past any resolution, and private credit funds face more pressure as Wall Street tightens its belt. We begin with a big issue, a world hoping for relief following the reopening of the Strait.
We need to see that traffic actually move now.
There's going to be a big deal at some point.
There's a lot of uncertainties.
There's damage that's going to persist.
The deficits will be larger. Inflation will be higher. We'll have less and later monetary easing.
And the top 20% of earners basically determine success or failure for this economy.
People are overplaying the K-shaped economy.
Consumer has remained intact.
Consumers will remain resilient.
The economy's resilience has been phenomenal.
The economy is still showing signs of weakness despite the comments about resilience.
There is scope for inflation to go higher.
I think we live in a world of higher, more volatile inflation.
Base case is that you'll stay around 3%.
Longer term, things have been quite stable.
Inflation's expectations are anchored in part because people think the Fed will do the right thing.
The Fed will be on hold and watch the data.
Now, stocks extending record highs once again today, but how about the performance of treasuries? Let's take a look at the daily moves right now. You can see there's a lot of green on the screen as yields just dropped. The biggest moves concentrated towards the shorter end of the yield curve. You take a look at 2s and 5s right now, and down between 8 and 9 basis points. The 10-year Treasury yield, it's still above 420, but it's lower by about 7.5 basis points today. And then the 30-year yield is where things maybe dissipate a little bit, but still we're looking at a drop of about 5 basis points. Let's take a look at the monthly returns there. This is an interesting chart and one to keep your eye on, because my understanding is that this doesn't include what we're seeing today. So that little green bar that you see over on your screen right now, would have to imagine that becomes a lot bigger after today. And you can see the month that we're coming off of in the month of March, a really big drop relative to the past year or so when it comes to treasuries. So again, a lot of volatility in this market still. But before the U.S. and Iran declared the Strait of Hormuz open, ECB President Christine Lagarde spoke this week in an exclusive interview about the importance of the passageway.
War is, in any circumstances, the worst outcome. If you talk in strict economic terms and the movement of goods and all that, it's the Strait of Hormuz not being open for shipping and transportation, because you have 20% of gas and oil going through that, as well as the like of ingredients necessary for fertilizers, ingredients necessary for microchips, and what have you, not going through the strait.
Bloomberg's international economics and policy correspondent Mike McKee joins us now with more. And it's interesting, Mike. I mean, you think about what we're seeing when it comes to the bond market itself. What about the economic data that's sort of underpinning some of the moves, which, of course, is still at best, but still tells us something?
Yeah, we're looking backwards, of course, with economic data, Katie, and what the data have shown hasn't told us much, except that consumers are much less confident about the way the economy is going, and they do think inflation in the short run is going up. As this month goes on, and as we move into May and get the April numbers, we're still likely to see a lot of negative impact from this war. Inflation may go down, but it's not going to go down immediately, because it takes a while for prices to fall, and it will take a while to see if we actually do have a deal that lets oil through. And remember that oil is going to take 3 to 4 weeks to get to where it's going. So a lot of impacts around the world, and it's only going to be slowly undone. And so that raises questions. And you notice at the top of the show, there was a lot of disagreement between the various Wall Street participants about whether the economy can remain resilient or not under these circumstances. I brought along a chart that shows where we are in the U.S. right now, and it does have a little bit of a warning on the right-hand side, if you take a look at what's going on with consumer spending and consumer incomes, they have both been weakening. Spending still hanging in there, as people were saying, but incomes weakened last month. And look at the savings rate has dropped off. We have kept spending because we're spending down money that we have in savings. And if that continues, if we don't see any kind of relief at the gas pump, then the economy is going to slow much more significantly. And that could happen even if the president announces a deal and he's telling us the truth.
Yeah, it's fascinating. It looks like that yellow line is through the end of February, so going to keep a close watch on where it goes from here. Mike McKee joining us from a mystery Bloomberg location. Hope to see you in person soon. Let's dig into all of what we're talking about with our first roundtable. Ashok Bhatia, CIO and Global Head of Fixed Income over at Neuberger, along with Meghan Swiber, Senior U.S. Rate Strategist over at Bank of America Securities. Fantastic to have you both with us. I'll start with you, Meghan, since you're sitting to my right here. I mean, you think about the news of what we're getting today when it comes to the reopening of the Strait of Hormuz. We already knew this was a very headline-sensitive market at the moment, but I mean, what do you make of these most recent headlines and how it translates through into the fixed income market?
Sure, Katie. You know, the move that we're seeing in the rates market, the rally that we have at the belly of the curve steepening that we're seeing is all very consistent with what we would expect in this environment. What we've been saying from a rates perspective is that we are really price takers on the oil front. And rates and oil are really some of the two asset classes that haven't been able to fully reprice what we saw since the start of the conflict. So we are long rates, and kind of given what Mike was just referring to in terms of the consumer backdrop, still seeing a lot of K-shaped nature to the U.S. economy. We think that top income cohort more likely to be able to weather this big uptick that we're seeing in oil prices here. And we're worried about the bottom part of that K. Our economists are still calling for 2 more cuts this year. We still like being long front end belly of the curve and like curve steepeners here.
Well, Ashok, come in on that point. I mean, you think about where the Fed is going to go. There's a lot of disagreement to that point. And I wonder, you know, when you put together the latest headlines, what you're seeing when it comes to the economic fundamentals here, where does that leave you?
Well, I think, you know, just a couple of points there. I think when we think about the economic backdrop this year, we think we will see, you know, weakening in the U.S. labor market. You know, the U.S. labor market remains pretty concentrated in just a couple of areas creating jobs. But, you know, you get below the surface there, we think there's more underlying weakness that over the course of the year will play out, and we'll see that softening in the unemployment rate that creates a little bit of a backdrop for the Fed to ease. I think on inflation, you know, take away the oil shock for just a minute. Inflation, you know, core inflation in the U.S. and a lot of the internal dynamics there, they have been pretty well behaved. And, you know, we think we are even with this oil shock, still on track for core inflation to be kind of declining towards the end of this year and be within sort of eyesight of the Fed's target. So if things play out as we expect, which is a little bit weaker growth as coupled with inflation that is more visibly returning to the Fed's target, we also, you know, as Meghan mentioned, we're also in the camp that the Fed will be easing this year. It doesn't sound like it's not the narrative today, but that's where, you know, we think the Fed will end up going. And then, you know, the last thing I'll just say is near term, you know, next week's going to be pretty interesting. We're going to hear from Kevin Warsh. And, you know, how he sort of describes thinking about the looking through of energy price increases, how he describes core inflation, that's going to be another important data point. And we think he'll be putting together a message that if things play out as he expects, the Fed will be delivering a couple of eases by the end of this year.
And Meghan, I'd love to bring you in on that point. I mean, you think about the fact that we are going to hear from Kevin Warsh, still a lot of questions over how he gets confirmed, but at least we'll hear from the man himself. How will you be listening to that? I mean, what sort of signs will you be on the lookout for?
Yeah, I mean, as hopeful as I am, Katie, that we're going to get something more significant from Warsh on the monetary policy front, I would advise against really taking too much of a signal from this yet. He's not in the seat yet. He's still got to play his political cards close to the vest. What we may hear a little bit more about from him is how he's thinking about Fed balance sheet, which has been a growing important topic in light of what we're hearing from a liquidity reg development front. Warsh has been historically quite hawkish on Fed balance sheet. In our view, really the only way that the Fed can get balance sheet much lower from here is if we change bank rules, if we allow banks to use discount window more regularly. That really is the only way that we can see the Fed turn around and do QT. Maybe we'll hear more from Warsh on the balance sheet, I imagine, than what we'll see from a rate policy decision.
That's a really good point. I mean, you think about when his name was first, when Trump officially came out and nominated him, certainly that was a big part of the conversation. And obviously it's early days, but Ashok, I mean, you think about the balance sheet. We pay a lot of attention to that one lever, and that is the rates lever. But I mean, talk us through how you're thinking about how Warsh might approach the balance sheet. Of course, he's just one of many when it comes to the Federal Reserve, but still his views matter.
Yeah, I think the Warsh message on the balance sheet would be, in an ideal world, the balance sheet would be smaller and would be exclusively or almost exclusively focused on treasuries. But I think that statement will come with a recognition that just with where the repo facilities and how they're functioning and the liquidity in the short-term market and how that interacts with a lot of bank regulations, the balance sheet really can't go down a whole lot from here near term without some changes to other policies. And I would expect he signals that the Fed will work with, Treasury and other institutions to affect that. So I think it'll be more of a desire message than a practical message of any change coming soon.
And Ashok, I would also like to get your thoughts on the yield curve because, Meghan mentioned it in the context of what we might get from the Federal Reserve. And it feels like a yield curve steepening, I mean, that has been the call for several years now for various reasons. And it seems like it always tends to break hearts. And I wonder how you're thinking about it, as we get deeper into 2026.
Yeah, I think the curve from these levels can steepen some more. The bond market, the Fed's only priced, it's not even priced for one ease this year. We're priced for about 50% chance of one ease by the end of the year. So, as easing expectations come back in, that should really help the 2 to 5 year point. Curve steepens, but I don't think it's going to be the dramatic steepening that we've seen over the last couple of years. Steepening bias, but more range bound than the dramatic moves like that we saw last year.
And Meghan, I am curious, I'm taking a look at your notes, and it seems like the belly of the curve is where you like to be. And I mean, duration has been out of favor for so long. There's so many cross currents right now. I understand the logic why a lot of folks wouldn't be looking at it right now. But I mean, what are some of the ingredients that you would want to see come together that might have you considering edging out a little bit?
Edging out further on the curve, Katie, to me is really a question about the supply-demand balance that we have in the Treasury market right now. Actually, just at the start of the program, we had the release of Treasury's refunding questionnaire to primary dealers. That's going to be moving into focus. Since the Feb refunding, deficit risks have only gone up. So we are more worried about the back end of the curve. We were hopeful headed into the Feb refunding that we would get some signal from Treasury that they're looking at reducing auction sizes out there. Given the fact that the deficit picture looked a little bit better, there were plenty of arguments that Treasury could have leaned on to make the affordability case in terms of bringing down longer-term borrowing costs. Though it really doesn't seem like this is on the agenda list for Treasury right now. And the question now really has become, when is Treasury going to be growing auction sizes? And I think that's going to be a big question at the May refunding meeting that we may begin to get some color on. And everyone in the market's going to begin to focus more on a lot of these risks, which we see mounting given the conflict and where we've been and just even interest rate levels over the past month and a half.
Absolutely. Well, guys, a fantastic way to kick off the show. Really appreciate you both taking the time. That is Ashok Bhatia at Neuberger, as well as Meghan Swiber with Bank of America Securities. Now, still ahead, a moment of interest. U.S. banks report earnings and disclose their exposure to private credit. That conversation up next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for our weekly segment of interest. Private credit certainly drawing interest on Wall Street. We heard from Oksana Aronov with JP Morgan this week about private credit's role in supporting distressed companies.
There are a number of operators out there that probably should have gone under even back in 2020 that are still around. And today we have this entire ecosystem of private credit that has made it possible, has financed companies that probably would have struggled otherwise. We see that through the bad PIK activity. We see it through the rising defaults in the private credit sector. And the way this plays out is the way it always plays out. People want liquidity.
And as you might expect, private credit was a major topic for Wall Street banks this week during their earnings reports. The group as a whole revealing that they've amassed roughly $180 billion of exposure to private credit firms. To talk more about this, let's bring in our reporter roundtable. Olivia Fishlow covers private credit for Bloomberg, and Catherine Doherty covers finance. And Catherine, I'm going to start with you because $180 billion of exposure when it comes to the big Wall Street banks. Put that number into context for us. How should I be thinking about it?
So if you're listening to the big bank CEOs this week, they all are using very similar language, which is, number one, they're saying we are in a very protected, we're in good position here moving forward. So they're not worried about that number that you're highlighting. And number two, part of the reason that they are saying they're in such a good position is because of the structural protections that they have in place. They went into greater detail on the call with analysts this week to discuss what protections that actually looks like. Number one, markdowns. None of the firms really discussed actually having to mark down, at least for Bank of America and Citigroup, both saying that they have not experienced any losses as it relates to their private credit portfolios. But moving forward, they're saying that that is some of the protections that they do have at their disposal when it comes to adjusting and handling any potential exposures and stress that they could see in the future.
And Olivia, I mean, we've been talking about pressure on private credit funds as it relates to redemptions, but you reported this week that they're also facing pressure when it comes to how Wall Street banks are approaching their arrangements with a lot of these funds.
Definitely, yeah. I think the scrutiny around private credit has extended to the banks where they're looking at the financing that they've extended to these funds and what loans are actually in that collateral and maybe moving some around to give them some more protection there.
Yeah, it's certainly an interesting story. And you have to wonder, I mean, how might this play out just briefly here? And have we seen a moment like this one before?
I don't think we've seen a moment like this one before because private credit has never been the size that it is today. But I think everyone's watching both bank earnings and BDC earnings very closely.
Absolutely. And we don't have to wait too much longer for those to start to roll in. Our thanks to Bloomberg's Olivia Fishlow as well as Catherine Doherty. Now, still ahead, it's our credit roundtable. We'll speak to Lindsay Rosner, head of multi-sector fixed income at Goldman Sachs Asset Management, as well as John Cocke. He is Deputy CIO for Credit at Corbin Capital Partners. This is Real Yield on Bloomberg.
I'm Norma Melinda. Let's take a look at your midday movers. First up, oil prices are plunging. That's as markets react to easing geopolitical tensions. The reopening of the Strait of Hormuz is helping calm fears of a major oil shock, easing supply concerns and taking some pressure off of energy markets. Meanwhile, U.S. stocks are extending their record-setting run. Investors are forgetting concerns that have weighed on the global economic outlook ever since the U.S. launched its war against Iran 7 weeks ago. In company news, Intel is surging to its highest level since 2000. That's as confidence in the chipmaker's turnaround story continues to build. Analysts say the rally could have more room to run with expectations for potential new high-profile customers, and some even see the stock trending toward the $100 mark over time. And finally, Netflix shares are tumbling. Earlier on track for their worst day in 4 years. After issuing a weaker than expected second quarter forecast, the outlook is disappointing Wall Street, coming just months after the company also missed out on a bid for Warner Brothers Discovery. Investors are also digesting co-founder and chairman Reed Hastings' decision to step down after 29 years. Those are your midday movers. I'm Nora Melinda.
Well, all attention is on the Middle East with Iran reopening the Strait of Hormuz. Let's get the latest with Bloomberg's Tyler Kendall joining us now. And it's not just the Strait, right, Tyler? I mean, we've gotten a flurry of headlines when it comes to communication between the U.S. and Iran. What's the latest that we're hearing, especially as it relates to uranium, for example?
Yeah, hey, Katie. Well, within the last hour, Bloomberg News now reporting that President Trump has told us that Iran has agreed to indefinitely suspend its nuclear program and that in exchange, the U.S. will not be unfreezing any Iranian funds. Couple this with a post from President Trump earlier today on Truth Social saying that Iran has agreed to turn over its stockpile of already highly enriched uranium. Now, we should say that Iran has not commented or confirmed any of these potential concessions so far, and recent comments from Iran would appear to push back that they were willing to negotiate on these points, but these would be very significant developments in these ongoing diplomatic efforts. Keep in mind, when it comes to Iran's nuclear program, we are looking for any details when it comes to enrichment as well as that enriched stockpile. Now, moving forward here, it does appear that President Trump was pushing back on some earlier reporting today from Axios that one of the potential options the U.S. was considering was in exchange for that stockpile of enriched uranium, the U.S. would unfreeze about $20 billion worth of Iranian assets. But according to President Trump telling Bloomberg News in a phone call, that option as of now is not on the table.
And talk to us a little bit about what we're hearing when it comes to perhaps conflicting reports when it comes to the Strait of Hormuz, because Iran coming out today and saying that the Strait is open. You saw that cheered by the administration, but then we heard from the semi-official news agency in Iran saying that it will close the Strait again if the U.S. blockade remains in place. So walk us through what the latest is there.
A lot to parse through here. Katie, you're exactly right. President Trump coming out in a post applauding Iran, saying that the Strait of Hormuz was open, but we need to pick out from the Iranian foreign minister's statement that it is only open through a, quote, coordinated route. And then Iranian state media saying earlier today that any vessels that do transit through ultimately would need to coordinate with the IRGC. So we'll have to see whether shipping companies are willing to take on that risk and transit through, because President Trump had also indicated that the U.S. was working to destroy mines, which raises questions about how safe that strait may be, though, of course, that is considered a crucial step to help expand commercial traffic. Now, the White House maintains that the U.S. naval blockade is in full effect and will continue to be in full effect after yesterday. We actually got an update from the Pentagon that the U.S. was expanding it. It initially, of course, applied to all Iranian ports, but now Central Command says that that also applies to any ships part of the so-called dark fleet.
All right, Tyler, really appreciate your reporting. That is Bloomberg's Tyler Kendall joining us from D.C. Up next, it's the auction block. Issuance soaring with funding costs increasingly attractive for new deals. We'll talk credit up next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the auction block, where we highlight the big credit issuance of the week. And it was the big U.S. banks dominating high-grade sales this week with massive deals. Bank of America, JP Morgan, and Morgan Stanley all with $10 billion sales. Plus, Goldman with a $6.5 billion deal. With these bank deals, overall weekly volume hit $58 billion, easily passing forecasts and driving the month-to-date total to more than $95 billion. April total volume is now on pace to be the busiest since 2020, and that's even with nearly 2 weeks still left to go. And looking at U.S. high yield, this week's supply of $15 billion makes it the busiest week since September and drives the yearly total to more than $100 billion. Notably, CoreWeave returned with another debt sale for a second consecutive week. Now, sticking with credit, Bloomberg's Lisa Abramowitz sat down for an exclusive interview with Morgan Stanley CEO Ted Pick on this very topic.
It's all credit. So all things being equal, if the economy is growing, credit does fine. It does fine. When there's a recession, credit struggles. And then the question is then, which of the borrowers were really doing the work around what's in underlying portfolios? How quickly was the capital put to work? And I think what we're going to see is we're going to see dispersion of returns among great asset managers.
Joining us for more on this, John Cocke is Deputy CIO for Credit at Corbin Capital Partners, and Lindsay Rosner, Head of Multi-Sector Fixed Income over at Goldman Sachs Asset Management. Fantastic to have you both with us. And Lindsay, I want to start with you because I'm taking a look at your notes, and you write that Technicals are strong here. Stay invested, but reluctant to add further risk. What is the calculus?
Sure. So I think it echoes exactly what Ted just said, which is if the economy is strong, then you can justify these valuations. However, I think we need to take a step back and understand in many cases, we're tighter from a valuation perspective than we were before the war in Iran. So that's key to think about. Do the fundamentals justify being tighter than we are here? And we think that there is some permanent scarring from the conflict that we've had thus far.
And I've actually had a lot of conversations about credit this week, and it seems like the consensus seems to be, Lindsay, that you want to pay attention more to the all-in yield rather than the spreads. Spreads are tight, but that yield is just too tempting to ignore. But how far can you really take that story?
So yield is what you take home. It's actually what you earn. And obviously the components are the base rate and then the spread that you're given on top of it to invest outside of safe assets. That yield has become more attractive. Look, the numbers are different as we speak right now than they were last night. There's been a reduction about 10 basis points in yields based upon the positive news that we got that the Straits are opening. But you are still standing at yield levels that are more substantial than they were to begin with. And these levels are still attractive to investors. And we've seen flows in our platform of yield buyers coming off the sidelines and saying these numbers make sense for us.
Yeah, and it's a good point that the price action today has been ferocious. But John, I do want to bring you in here because, you think about what's going on in private credit, the turbulence that we've seen there. It's not necessarily related to what's going on in the economy. It's more about software exposures and, the existential questions that AI poses. We were just talking with one of our Bloomberg reporters that you think about the size of the private credit market right now. It's unlike what we've seen in past episodes of stress just because it is so much bigger. So in some ways, this feels like the first real stress test.
Yeah, you've had market prognosticators call it the adolescent phase or a hiccup. And I think that's right. As we look at the opportunities out there, dispersion creates opportunity. Change creates opportunity. So what we're seeing now is a great entry point. You had the golden age of private credit a few years ago. A lot of money was raised in these interval funds and non-traded BDCs, and they had a mandate to invest the money. The supply of that is private equity deal flow for direct lending strategies. So they bought what was on offer because they were raising capital for that. Now we've gone 3 years and there's been change. So some of those deals that were underwritten by private equity firms at the time look like they're going to have a different outcome because of technological change. I think the credit may or may not suffer in that. We'll see, as valuations change in public companies. But what we are going to see is a tremendous opportunity in the market to go deploy capital again, because now you have dispersion of outcome, creating less capital in the market and new knowledge to go create new opportunities.
Does that opportunity set, John, extend to software? Obviously, it is the dirty word when it comes to private credit right now. But I mean, could you make the case that some of these assets, some of these loans are perhaps being thrown out with the bathwater here?
Yeah, absolutely. There are good software businesses, and I'll call them at-risk software businesses. Thankfully, our firm has not participated in a lot of that over the last few years, so we don't have a lot of exposure, but we are starting to see opportunities out there to go buy what we think are the best ones. We've heard some of the large private credit firms are at the margin selling part of their book. They might be trimming to manage position size or to create a little bit of liquidity. The structures really do help these firms, but it's great if you can go buy a really well-covered loan a few points cheap.
And Lindsay, I mean, bring this into the world of public fixed income, because there was that concern, especially, in March, that we could see some of the stress in the private markets sort of bleed into public credit, especially when you think about all of these big tech issuers coming into the market. But what have you seen from your chair so far?
Yeah, so I think there's two things going on there. You have companies that have the ability to go into private credit to finance themselves. They can also go into the public market. So that flexibility, you're going to see flows based upon what's healthier and where there's more money that can be put to work. So it's important to understand what's going on in private credit, what's happening in terms of redemptions, interest, and therefore that may change issuance patterns as it pertains to the public side. But picking up on something that John said, the second point that I'd like to highlight is that what you are looking out for, potentially concerned about in private credit, also matters on the public side. And specifically for us, what that would be are concerns about the software companies that are potentially disruptible by AI. And as a result, we have leaned into high yield over bank loans. Bank loans is much more sensitive as a sector to software, but it really is about doing that fundamental work bottom up and figuring out the names that are going to do well and have that moat around them. What's really interesting, if you pull the camera back, where are we year to date? The places that haven't bounced back and are actually still wider year to date are two areas: bank loans and Europe high yield. So does that make sense? And from our vantage point, given everything that continues to be a theme, concerns about AI and disruption, and then also this inflation shock that doesn't just go away because we get a positive headline this morning, that's something we still need to consider and we still think is at play.
Yeah, I mean, well, talk us through how that specifically relates specifically to European high yield, because, you know, the consensus out there in the market is that what we're seeing when it comes to energy shocks in the U.S. and in some of the prices, it's going to be much more acutely felt when it comes to Europe and Asia too, but, you know, sticking to Europe here.
Yeah, so when you think about the European economy, they don't have energy in the way, for example, the U.S. made a big national security move to make sure that we can provide our own energy. Europe is not in that position. And simply put, at high-level statistics, our forecast is that the U.S. grows at 2.3% this year. Euro area, we think, grows at 0.7%. That difference in GDP output and macro backdrop has a lot to do with what valuations make sense. And therefore, U.S. should trade tighter in high yield or even across investment grade and structured product than things in Europe. It's the rel-val.
And John, I mean, come in here, because especially when it comes to what we're talking about in private credit, a lot of this is a U.S.-centric story. At least that has been the lens through which it's being viewed. But I mean, do these concerns exist outside the U.S. from what you can judge?
Yeah, I mean, certainly. Private credit is an enormous asset class. Some people often conflate different parts of it and just say everything in private credit is sponsor-backed direct lending to private equity portfolio companies. But in reality, there's a lot of market segmentation. There's non-sponsored lending. There's asset-backed lending. So when we look at the opportunities out there, we are always taking into account macro factors. And Lindsay's right. Like, there are different input costs to industries around the world, and they just change dramatically. So the great news is if you have dry powder out there, you have less competition because a lot of the capital now is on the back foot and paying out redemptions. So you can go make decisions and play offense for companies that have lower input costs here in the U.S., and you can find sectors to avoid.
All right, John and Lindsay, great discussion. Have to leave it there. That is John Cocke of Corbin Capital Partners and Lindsay Rosner of Goldman Sachs Asset Management. And if you can't get enough talk on credit, please check out the Bloomberg Credit Edge weekly podcast. That's on the terminal and wherever you get your podcasts. But still ahead, it's our Muni moment. New York Governor Kathy Hochul has proposed a compromise with New York City Mayor Mamdani, a new tax for second homeowners. President Trump, meanwhile, says the new taxes, quote, are destroying New York. This is Bloomberg Real Yield.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are extending a record-setting run. The S&P 500 heading toward its biggest monthly gain since 2020. This comes after the reopening of the Strait of Hormuz promised to ease an oil shock that's darkened the global economic outlook. As a result, oil and European natural gas prices are tumbling, hopes raising that the unprecedented disruption to the critical shipping artery may soon be nearing an end. Among individual movers, energy stocks are under pressure, with Exxon, Chevron, and ConocoPhillips tracking that drop in crude. That's as lower oil prices threaten to weigh on profits across the sector. And finally, U.S. airlines are catching a bid, with cheaper jet fuel expected to ease costs and boost profitability. Fuel is one of the sector's biggest expenses, so any sustained pullback in oil could be a meaningful tailwind. Those are your midday movers. I'm Nora Melinda.
And it's time now for our Muni moment. President Trump says New York City Mayor Zohran Mamdani is, quote, destroying New York with the latest proposed tax policies. President Trump posting online, quote, sadly, Mayor Mamdani is destroying New York. It has no chance. The United States of America should not contribute to its failure. It will only get worse. The tax policies are so wrong. People are fleeing. They must change their ways and fast. Again, that was the president posting on Truth Social. Joining us live with more is Bloomberg's Neha Cotton. And let's start there with this tax on second homes. And you think about just the relationship that Kathy Hochul brings to the situation, because she had opposed a blanket tax when it comes to millionaires' income taxes. So why was the second home tax perhaps a little bit more palatable?
Right. She found a compromise with Mamdani where she would tax a sliver of New York's wealthy, but there are the wealthy that don't live here. They probably don't vote here. And so she gets around taxing a broad swath of millionaires, which is what Mamdani wanted to do, but she still gets to say, I'm taxing the rich. And, these are not, most of the voters, they don't live here. It doesn't have the same impact.
What does it mean, though, when it comes to the impact potentially on the luxury market? Because, you think about a lot of those second homes, they're being used as pied-à-terres, for example.
Right. And that's where she's focused on, is the pied-à-terres. She says this won't have much of an impact, but the real estate market, and agents think otherwise. They say that the luxury market really depends on these pied-à-terre transactions. And for example, Corcoran has one team where 40% of their real estate sales for luxury items are for pied-à-terres. There's a concern that, for example, the $5 million cutoff, because you only get taxed if your pied-à-terre costs $5 million or more, will cause people to start buying homes in lower tier markets, like $3 million, and that will flood the rest of the real estate market, where homes, as we know, are, there's not a lot of homes.
Right. Yeah. An interesting sort of trickle down situation there. Yeah. Let's talk about this moment in time, though, because this sort of tax, it's been on the table, floated in various forms for years now. So what is different about this period?
Right. Well, it comes when other states, other democratically led states like Washington and California and Massachusetts are proposing their own wealth taxes, or just taxes on assets where it makes it perhaps more likely to pass. Back in 2019, there was an attempt to do this. It failed in New York, but now you have these other states that are coming on board. There's more of a push to tax the wealthy. So I think, and Kathy Hochul, she's the main obstacle here. If she doesn't want to pass it, she doesn't, and she's already decided she's going to, so.
All right, Neha, really appreciate your reporting. Certainly a very interesting and hot button topic in New York City. That is Bloomberg's Neha Cotton. Now, staying with munis, some public schools are getting an AI revamp for their budgets, embracing tools like Microsoft's Copilot to target crippling deficits. It's moving the needle in places like Florida's Broward County, where officials hope to save $50 million over the next 5 years, mitigating a record $100 million shortfall. Joining us with more is Bloomberg's Erin Hudson. Erin, such an interesting story. Let's get specific here. How exactly are schools using these AI tools to address their budget situation?
Yeah, so the schools that are systematically adopting AI, they're thinking about this in terms of using AI tools to identify savings in terms of dollars or time. In the case of Broward County, they're looking at chipping away at their deficit by looking at energy bills, maintenance bills, that's that $50 million over 5 years. And over the year to date, they've also been kind of just analyzing overtime staff hours, for example. So year to date, they've actually saved $12 million so far, is what they tell us. So yeah, the districts are sort of looking at this as a way to help address their budget challenges, which are really strained at the moment with the pandemic aid ending and enrollment declines, which is the driver of Broward County's deficit.
Absolutely. Well, talk to us a little bit about which tech companies are involved. Which firms are seeing this as an opportunity?
Yeah, it's all the big ones. Google and Microsoft they're already in the K-12 space in a big way. So some districts would say they kind of have a little bit of a starting advantage, but a lot of companies are moving in there. OpenAI launched their K-12 offering in November. And then there's also a world of startups. So we mentioned one in our story. It's called Magic School, and it's using Anthropic's AI models to build out its platform, its chatbot, and other tools. And really it's called education technology, or ed tech for short. That's a really big spending market. It's about $30 billion as of 2024, and it's only projected to grow and double by 2033. So there is no dominant player at the moment. So that's the space that these tech companies are looking at trying to get into.
And what does this mean for investors here? Because you think about the sort of composition of the muni market. Obviously, these K-12 schools are a big part of that.
Definitely. And for investors in school bonds, the way they think about it is kind of how are district leaders managing their budgets. So in theory, if AI tools are helping district leaders manage their budgets more effectively, address deficits that exist or shortfalls, that in theory is credit positive. But it's very early days. It's 10% of schools out there are doing this. So it's going to be interesting to see how it plays out and if the AI tools deliver on the promises that these school leaders are hoping that they will.
Absolutely. Well, Erin Hudson all over the story. Our thanks, of course, to our Bloomberg News reporters. Now, still ahead, it's the final spread. The week ahead features Fed Chair nominee Kevin Warsh facing a confirmation hearing. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead coming up. Reportedly, there are possible U.S.-Iran talks on Sunday. And then on Monday, we get a slew of regional bank earnings and commentary from the Wells Fargo CEO. On Tuesday, the Senate will hold a confirmation hearing for Fed Chair nominee Kevin Warsh. Wednesday, earnings from Tesla and IBM, as well as from Southwest, Boeing, and AT&T. Then on Thursday, Warner Brothers Discovery holds a special shareholder vote on the merger with Paramount Skydance. And then on Friday, to round us out, UMich consumer sentiment, and we'll also get some inflation data from Japan. So certainly a lot to look forward to. But for my final thought, let's look ahead to that confirmation hearing for Kevin Warsh. Bloomberg's Enda Curran joins us now from D.C. And of course, there's still a lot of questions over how a confirmation for Kevin Warsh would actually work. But let's talk a little bit about the substance here. What are we expecting we might hear from the nominee next week?
So you've got the politics and the policy. On policy, to your point, it would be interesting to hear whether or not Mr. Warsh maps out the kind of dovish messaging that he was sending in the months before he got the nomination. Does he believe interest rates can go lower? And if so, how does he plan to do that and by when? And of course, Katie, the other point is his competition in the Iran war and how does that complicate that outlook? So in terms of policy itself, lots to think about. Balance sheet reduction, his views on QE, all of that side of it. And then there's the politics or the institution. What message will he send on standing up for the Fed against political interference? What changes will he make to how the Fed operates? Internally, we know he's been very critical. Plenty of others in the White House have been critical too. So it's really the first opportunity we're going to get to hear from him since his nomination, and there's going to be a lot of ground to cover.
And in less than a minute here, just bring us up to speed on the politics side and what we're hearing from Tillis, of course.
So no sign of an off-ramp for the Department of Justice investigation into the Fed on allegations of overspend on the renovation of headquarters. That's carrying on, Katie, as is. On the other side, as you mentioned, Senator Tillis, a key swing vote on the committee that is meant to confirm Mr. Warsh. He says he's not going to approve anyone until that DOJ investigation comes to an end. And as I say, right here, right now, there is no sign that investigation is going to conclude.
Yeah, and no off-ramp, as you say. Really appreciate the preview there. That is Bloomberg's Enda Curran. Meanwhile, you take a look at the S&P 500 today. Not quite at session highs, but pretty dang close. The S&P 500 higher by about 1.5%. That is mirrored with a rally in the bond market. Yields dropping across the curve, really concentrated when it comes to the front end, though. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg. you.